Good afternoon. I just want to put together a quick video, take a look at the indexes, kind of share my thoughts, and then review our holdings just to manage expectations, what we can expect to see play out in the coming weeks, what would be good versus what would be bad. So without further ado, let's jump right into it. First things first, the S&P 500. We broke out here in mid-September, and we've since had a pretty substantial move for the S&P 500. However, between September 19th to November 5th, about a almost 2-month period of time, we largely went nowhere. However, since the election has passed, we got a pretty significant move. We're up almost about 5% in about 6 days. So it looks like now that the election's behind us, a lot of anxiety has left the market. As you can see here, the VIX was down almost 20% following the election's closure. Some calling it that the Trump trade is on. Whether looking at things as objectively as possible, whether it be because investors are happy with Trump and his policies and think it's going to benefit the economy, or it's just something as simple as uncertainty being lifted from the markets. We do have a powerful technical move, and as a result, we've had a lot of powerful moves from individual stocks. If we take a look at the most recent move from the S&P, we have this large unfilled gap, which is a sign of strength. And not just that, but we also had 2 days, basically 3 days of follow through before finally seeing our first red day since that initial move up in a very controlled manner. So the price action is very conducive for continuation to the upside. We are short-term extended, as you can see. We're pretty extended from the 20 moving average here. We're about 3%. We don't generally get more than 4% before seeing some sideways consolidation. So that's exactly what we would expect here in the coming days. Some consolidation. I think the market's earned it, and then maybe after a week or two, a continuation to the upside. We'll kind of take a little bit deeper of a look as to what we can expect in the coming weeks with IWM. But first, I want to just cover the large cap names. So that was the S&P 500. You're going to compare this chart where the price action is relative to the basing structure with the NASDAQ. And you're going to very quickly see that the NASDAQ is just erupting out of this base now, whereas the S&P 500 has been out of it for quite some time. So what is that telling you? It's telling you that the tech sector has been lagging significantly, and the other indexes in the markets, consumer staples, consumer discretionary, utilities, etc., have all been outperforming the tech sector. So although that's the case, NASDAQ did finally break out of this base, and we are now moving sideways. We're consolidating. We're digesting that most recent move higher. I think that's very expected after a 6% move in such a short period of time. I did point this out in the newsletter recently, and I have several times in the Discord that consolidation here is perfectly normal price action. And actually, the type of consolidation we're getting here, which is tight and moving sideways, is very conducive. It's exactly what you would want to see versus some sloppy price action like this, where you can see we have this explosive move higher, and then we start to consolidate, but we get real loose and we pull in pretty hard the short-term moving averages, and then end up just completely getting annihilated, almost 6% in a short period of time. So this is the kind of price action you want to see. We go back here to, if you can recall, when we emerged out of this corrective structure back in, what was this, November of last year. So ironically, we're breaking out of a basing structure the same time that we did last year. Take a look at the price action. You can see it's very tight and controlled. Where do we find support? We found support at the 20 exponential moving average. Then we started our next leg up. Here was a little bit of a scarier pullback. However, it was contained within 5%. We found support that 20 moving average. We did break below it briefly. However, there's a 3-day rule that I've learned. You break below that 20 exponential moving average. If you can recapture that 20 exponential moving average within 3 days, it's usually a sign that the bulls are back in control. We then continue higher, and then you can see as this trend continues to mature, and get more and more extended. We're now 20% as we're starting our third leg up. The price action starts to get looser and looser, and then it just gets very ugly and difficult to trade. This is what you'll generally see. It's usually a sign of distribution. Okay, this is what you're going to see at market tops, whether it just be, medium term market tops where, you'll break down and then you'll continue higher, or it's going to be a major market top like we saw right here. The price action starts to get very, very loose. Okay, that's a bad sign. It usually means there's a lot of emotion in the markets. So with that said, what we're looking for here is for tighter price action, and at the very worst would be a test of the 20 exponential moving average before continuing higher, just like we saw here, just like we saw here, just like we saw here. We take a look at IWM, which is what I want to really dive a little deeper into with regards to, so we can manage expectations. We can see that this move has been about 11%. And now we're kind of we're beginning to consolidate. It's our first red day since or I would say second, but this is barely. It's down almost just 0.5%, and a stock that has almost 1.5 ADR. So this is our first real profit-taking day that we're seeing. Now, we want to manage expectations just like we did with the Qs. With the Qs and SPY, we want to see tight price action, and we want to see support at the 20 moving average, that orange line. The IWM would be fairly similar. But I can give you a little bit more, another example here. You could see that was 11% move higher, right? So let's take a look at previous moves from IWM, previous precedents that are very similar. Here we have about a 9% move. However, we had a very, very harsh pullback. It was about 5.5%. We did find support at that 20, the short-term moving averages, before breaking higher. That's not what we would really want to see. That would be, we would want to err on the side of caution if we were to see price action like this. What we would want to see is something just like this, where we then break higher. We're up about 9% in a short period of time. You have that 3-day momentum thrust, and then you have this you can see the price action gets really tight. What that's showing you is that the dominant force has a firm grip on the market. Okay, if you get like this, what we saw here, where it was about a 13% move in a 6 to 8 period of time, followed by loose price action like this, it's showing you that there's this big tug of war between buyers and sellers, and it's not conducive for further upside. You could get it. As you can see, we actually started to tighten up a bit here. We were loose, and they were getting tighter and tighter. However, what we really want to see is just tight price action throughout the entirety of the consolidation. We did end up breaking down here. The only point I'm trying to make here is you develop an eye for the different patterns. Everyone knows what a bull flag is, what a bear flag is, what a cup with handle is, and stuff like that. However, you want to start looking at all the patterns through the lens of probabilities. Probabilistically, what are the odds of this bull flag breaking out to the upside versus this bull flag? This bull flag is a lot more likely to break higher because of the price characteristics that are being played out within. Tight price action on a dry up in volume, resumption of the trend. Here, loose price action on volume less than that of the initial advance. However, these 3 days here were quite concerning. They were pretty high volume. And then we finally broke down. So let's say we're looking at this with a grading system. I would say this would be maybe a B+. Why would I say B+? Because we are below the 200 moving average, which is a very tough resistance. And then with this one, we are above all of them. I would give it probably a C plus at the best. So that's just kind of a general idea of how I'll look at patterns. It's not as simple as this is a bull flag, I want to go long. I grade it, and based off of that grade, I have conviction. So what we want to see with the IWM would be nice controlled price action within this range ideally, and then we will resume to the upside. That's what I'm looking for in the coming days. Now, all four of the indexes, this one, it just measures the medium caps. They also look great. Very similar picture to IWM. However, you could see medium caps are a little further above the base high, which means medium caps are showing a little more strength than the small caps. they all look great technically. We know what to expect now. We're looking for a week or two of consolidation. Doesn't mean we're going to get it. We could just grind higher. However, ideally, as swing traders, position traders, we would like to get that pullback, the consolidation, so stocks can really set up for us to get involved with. But there is always the chance we just grind higher using the 10 exponential moving average as support. If we do consolidate, we'll look to get involved with the leaders. Technicals look great on all the indexes. Let's quickly take a look at the internals. You can see we've had this real big expansion in net highs, which is exactly what you want to see play out in the market internals during powerful technical advances from the indexes, because it's showing breadth expansion in terms of market participation. So if we just go back here and smack a line using the high of the election day results, you can see we haven't really had an expansion of net highs since back in the COVID bull market. So this is the first time in this bull market that we're really starting to see small caps get involved. Ironically, when we had that, we actually saw a correction begin during this expansion here. But it's showing us that the engine of the market, if you will, is looking very primed and ready to go. So whenever I see strong technicals supported by healthy market internals, I really view the market through a more aggressive lens, and I'm a lot more willing to buy pullbacks. This is what I would call a pullback market, one where I'm really willing to get involved wherever that pullback opportunity arises. So indexes look great. Market internals look even better. It's a really conducive market environment, and I'm hoping we get a continuation to the upside. No one can know, but so far the technicals are really supportive of seeing just that. So now if we review our holdings, we can see HIMS cooling off a bit, down about 4%, which is nothing. You can see average daily range is 7%. So as long as you're not down more than the average daily range, the move is not significant. Okay, so if we were down about 9%, it would be an outsized move, and it would be therefore a significant downside day. You look at IWM, average daily range is 1.3%. It was down 1.8%. That's a significant move, significant downside day. However, factor in where this price came from in the last couple of weeks. 2% is nothing compared to this, 5% day up, right? Or this 2.5% day up. It's just some profit taking. It's the first real profit taking we're seeing since the beginning of this momentum thrust. Nothing to be concerned with, as we kind of just reviewed briefly. But just want to give a brief idea of what an average daily range is. It's calculated by looking at the last 20 days of the stock. How much does it tend to move on a daily basis? And that's how you get that percentage number. So looking at MSTR, up 5%. So continue to push higher today thanks to Bitcoin being up another 2%. So really outperforming the market. I would expect some kind of consolidation in the coming days. Looking at HIMS and looking at, actually, let's look at MSTR. What has price really been finding support at? It's been finding support at the 10 exponential moving average, really since throughout the entirety of this move higher. Maybe at one point it broke below the 10 EMA. Maybe you could argue it found support at the 20. However, there's a little bit of error there. Either way, the reason I'm bringing this up is because this is how I will manage my stop loss. I'll trail the position. If it's finding a lot of support at the 10, and it has been doing that since the inception of this uptrend, I'll tend to use that 10 EMA as my supportive trailing stop. However, with the portfolio, we are really looking at these positions through the lens of a position trade, meaning we're looking to hold them from anywhere between 1 month and 3 months, sometimes even longer if they allow us, and there's really some technical strength that's lasting. So with the longer trade duration, you're going to want to really use a longer moving average to trail the position. So with most positions here, I'll be using the 20 exponential moving average to trail the position. However, if you're a swing trader, more likely than not, you're going to want to kind of rear towards using the 10 exponential moving average as your trailing stop. Whatever you choose, it's completely up to you. However, do know that you should manage your position based off of the trading style that you would like. Use the portfolio, the setups as trade ideas, and then manage it how you'd like. If you prefer to manage it the way I do, which is going to basically, you're going to see in market environments where they're not as conducive technically as what we're seeing right now, there's going to be times where you're up 25% and then you'll give back most of it. So it can be really frustrating to be position trading in those kinds of environments. However, when you're really powerful environments like this, that doesn't happen as much, but it can still happen. So just kind of manage your expectations from a psychological standpoint. So, you last in the market and you don't, tap out or anything like that. With that said, MSTR, I'll be trailing it more than likely with the 20 exponential moving average, in combination with maybe some kind of candlestick pattern, stuff like that. I'll keep everyone posted. Affirm, this is a medium cap stock, about 18 billion market cap. However, it's very closely tied to IWM. Reason being, it's just a lender, so tends to be viewed as a more high-risk company to invest in, and as a result, it moves very closely with the Russell 2000. So what we want to do is we want to compare the price action of the stock, the individual stock, to the ETF, that basket of stocks. You can see it's green, and the IWM is red. So this stock is showing superior strength to the broader market, to its peers. And this is exactly what you would want to see from a stock you're holding on a red day for the markets. Okay, it's proving itself to you. It's proving its value to your portfolio. If it were down very sharply and it was outside of the average daily range, it would be a name where you'd want to pay very close attention to and consider cutting ties with if that weakness persisted. But Affirm really looks like a basketball being held underwater. And once that market pressure comes off of it, it could spike even higher. So I love the price action here from Affirm. OS, we got involved with yesterday. It's a small cap, I think it's 7 billion, 8 billion market cap. We'll compare today's price action to IWM. Take a look at the average daily range. It's only down about 2.5%, so it's not a significant downside day. Take a look at the wick there. We'll compare that to IWM. You can see there's not nearly as much wick on IWM. So what does that tell us? It's outperforming its peers. Tesla, I've said it several times in the Discord already, or I did yesterday at least mention it. We were forming a doji, which represents indecision, on high volume, which is generally what you're going to see, either it be a doji or some kind of inverse candlestick like this. I also have it marked here. They tend to mark temporary tops, whether that be a top for 2 to 3 weeks, followed by continuation to the upside, or a significant top where this ended up being the top for basically, 5 months. So what we're seeing right here, if we were to take a look at it kind of through the lens of like intraday, it's kind of like churning of price. You got a large exchange of hands, which is being demonstrated by the volume. So when you get that, it usually is telling you that institutions are exchanging hands with euphoric retail, and that's why it tends to act as a resistance. So really what that's telling me, what you generally see is if this is going to continue to go higher, which it's up almost 70% in a month, which is, I'd say it's a pretty significant move for a $1 trillion stock, is after maybe 2 to 3 weeks of consolidation, find support the 20 EMA and then a resumption higher. That would be the bull case. We have more than enough cushion on both options and our shares to hold through that and give it a chance. We've only had 2 legs up. There could be 3, even 4, maybe even 5 if this is a true leader. So I want to give it as much room as possible. So price action to be expected. It's still healthy. Let's see how it acts in the coming days. There's still a lot of air between the short-term moving averages and price. Wouldn't be expected to see another day or two of downside, and then hopefully we find some support and resume higher. Toast, stand out today, actually moved almost 4% higher, really outperforming the broader market. This following its earnings on Friday of last week, where it gapped about 14%. Price action, obviously exactly what we want to see if you're holding the stock. Just going to let it work. Once again, whereas I've been finding support the last couple of months, that 20 EMA, we wouldn't want to lose that 20 EMA. If it did lose that 20 EMA, that's a character change. If we get that character change, doesn't necessarily mean you have to get out of the stock, but it does tell you want to pay a little bit more close attention to it to see if it could be really finding a top and reversing. So everything looking good there. Netflix, we finally got our first target today for a nice, 9%, I believe. A nice little 6% gain, actually, or $50 gain per share. So we got involved with this on the earnings gap. It really, was pulling teeth. We had to hold to this 2B consolidation. It built that bull flag and then finally erupted higher. Everything looks good here. As long as it's above that 10 EMA, we're in good shape. Even if it breaks below it, we could find support at 20 and continue higher. But so far, everything's looking good. And then finally, Halo. So Halo, we also got involved with yesterday. This is a biotech stock. This is also a small cap, about 8 billion market cap. What I thought was interesting here is, let's take a look at first average daily range 2.8. It's down about 2.4%. So this was not a significant downside day. Take a look at its peers, this is the biotech ETF. This was down almost 3%, almost twice the average daily range. So that is a significant downside day. So this is really holding up well compared to its peers. And that's exactly what I want to see from a stock on a red day for its group, right? It's really proving itself, right? So with that said, XBI, just taking a little bit closer look at this. Here we have a basing structure. We attempt to break out, we fail, we then reverse. Whenever you get a failed breakout, it's actually in the portfolio. You see it often. If we take a look here, one of the setups is failed breakout pullback to the 21 EMA. We go back over here. This orange line represents the 21 EMA. So a lot of times what you'll see is a stock will break out from a base, it will fail, it will fall back in, and it will find support around the 21 EMA, and then attempt to break higher again. So this, my point is, we're right around a supportive area where you'd expect buyers to come in if this is truly going to try to go higher again. If that's the case, it's going to take pressure off of Halo, which was already holding up very well, and hopefully that allows this to explode higher. So everything here, all of our holdings look great. TSLL is just Tesla, but leveraged, allows us to get some exposure to the options for a little bit cheaper than obviously Tesla itself. Here's some names I'm watching. Don't want to take up any more of your time. If I see any meaningful setups, I'll obviously add them to the portfolio. Here's just one. Shop exploded at this large base today. Larger the base, the larger the move that tends to follow. What I'm looking for here is a first pullback to the 10 EMA. Okay, so when you have a large gap, and then you tend to find support at 10 EMA if that move is truly going to be strong. Let's look at Tesla. So Tesla, we bought it right on this day here. So I was a little above the 10 EMA, but that's just kind of give you a general idea of what we're looking for here. The same thing that played out for Tesla, that first pullback to the 10 EMA. And by the way, going back to the 21 EMA failed pullback buy, that's exactly what we did for Toast. So you can see we broke out of this base. It was a failed breakout. We bought it right around that 21 EMA, and that's what allowed us to get involved and make almost 44% on this stock so far. So it's been very kind to us. It's nice to see examples of these setups and how they've played out for us. And that's exactly what I would be looking for with Shop. So pullback to the 10 EMA, similar to what we saw with Tesla. We'll look to get involved and hopefully ride it up to some profit. So that's kind of where we stand right now with our positions. Indexes look great. Market internal is even better. All of our positions I'm satisfied with. There's no real reasons for concern with any of our positions. As long as the market holds up well, these guys should continue to power higher. You guys have a good rest of your day, and thank you for joining me.